Hello and welcome to another T-Valley video. Today we're taking an in-depth look at Tesla Incorporated, ticker symbol TSLA. We'll dive into financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Tesla Incorporated is an American multinational automotive and clean energy company. Headquartered in Austin, Texas, it designs, manufactures, and sells battery electric vehicles, stationary battery energy storage devices from home to grid scale solar panels and solar shingles related products and services. As of today, the 23rd of October 2024, the stock is priced to $217 with a market cap of 696 billion. And let's dive into some key valuation metrics. The price to earnings ratio stands at 93.1 and the price to cash flow ratio stands at 60.3. The median PE over the past 10 years was 73.3. Over the past 5 years, the company's revenue has grown by 293.7%, and its bottom line has increased by 1,839.7%. In terms of earnings per share, there has been a growth of 1,533.3%, and notably, the number of common shares outstanding is 3.18 billion, an almost 20% dilution over the period. Now, let's assess the company's liquidity and solvency. The interest coverage ratio is 27, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 1.4. This suggests a good ability to handle short-term shocks. And the long-term debt equity ratio is 0.11, and the total debt equity ratio is also 0.11. This suggests a very low debt load. This is very good. In fact, if we compare this to the rest of the auto industry, this is great. Ford, for example, has pretty big problems with their debt load, so Tesla is sitting on a great position from this point of view. Shifting to the cash flow statement, cash from operations stands at 13.2 billion, reflecting a growth of 451.2%. Cash from investing activities is minus 16.5 billion, with a plus 1,000% change approximately, while financing activities are at 2.6 billion, showing a almost 70% change over the period. CapEx has increased by fivefold, and free cash flow has grown by 32.1% to 2.3 billion. This is probably because, not probably, this is because CapEx has increased a lot. Although the cash from operations has increased a lot, their CapEx has also increased a lot, so their free cash flow has kind of got hit like a truck. Uh, Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 19.9%. The return on investment is 18.8%. The return on assets is 11.7%. And most importantly, the return on invested capital ROIC stands at 10.2%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 9%, a revenue growth rate of 15% for 10 years, and a perpetuity growth rate of 2%, we arrive at a fair value of $54.29. Secondly, using a multiples valuation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $56.1. And thirdly, the honest price target is $209.4. Putting it all together, you get an intrinsic value of $106.6, and of course, using a 15% margin of safety, you get an acceptable buy price of $90.6, suggesting that the stock at the current levels is overvalued. Now, to wrap up my analysis, I rate Tesla as a sell, and I know, hold your horses, I know there are a lot of Tesla fanboys out there, but this is, after all, only a auto business. My problem with the business itself is not that it's badly run. In fact, it's very well run for a car business, but they really show no more growth prospects. I mean, this year they actually will show a slight decrease in a lot of their critical indicators like free cash flow, net income, and so on and so forth. So I believe that Tesla's growth run has kind of gone out. Now, maybe their energy segment that's increasing very fast, so maybe that will in the future take over the main business, become the main business. But until then, I think Tesla is still an auto business and they're trading at insane valuations for one. I mean, if they were trading in the even in the 60 to $70 range, they'll still be very overvalued for a car company. But I believe that mm, their main problem right now is their capex, since they have big cash flow operations, but their capex is absolutely insane. It's basically grown fivefold, and their free cash flow is growing more like a mature business. I mean, in 5 years to grow by 32% is the best sign for your business that this is just too much capex. And what I didn't show in the video is that the few quarters at the start of 2024 were actually on minus free cash flow. So this is a pretty bad situation from my point of view. So I'm not sure. This is probably a ad from Tesla to get back to their to their pre but 2022 pre-2023 levels of growth. I mean, they're basically being beaten by Chinese cars in China. In Europe, Europe is enacting tariffs, and they're in the US. A lot of people don't really want to buy EVs, so they're getting hit from all sides, and probably capex is going into improving their self-driving. But now, as an investor, of course, all that matters, at least for me, are numbers. And as I've mentioned before, and I will reiterate again, their price is too overvalued. So I would rate them as a buy at about sub 60, sub 50 levels. Maybe sub 70 levels, because you could say that they deserve a premium for their well run balance sheet, their great brand, but yeah, less than more than 70, and it would be absurd. Now, thank you for watching. If one is video helpful, please like and subscribe for more deep value analysis. See you in the next video. Bye.